Hi everyone, welcome to my channel. In this video, we would be covering the topic International Parity Conditions. This is part of CFA Level 2 Economics, Chapter 1. In this chapter, actually, we would be covering 5 international parity conditions. We would be covering 5 international parity conditions. Those are, the first one is covered interest rate parity. Actually, we have already learned about this in one of our previous video for this chapter. I guess video number 1.6 on forward rates. I have given the link for this video in the description. You can watch that video before learning covered interest rate parity because it already gives it already uh, describes what a covered interest rate parity is and the formula for it. After that, we would be studying uncovered interest rate parity. Then we would be studying forward rate parity, purchasing power parity, and at last, international Fisher effect. These are the 5 international parity conditions that are being covered in this chapter. Before diving deep into what are these 5 different parity conditions, let us understand what do we mean by parity conditions. So, parity conditions are the basic building block that describe long run equilibrium level for exchange rate. It is the basic building block that describe the long run equilibrium level for exchange rate. Like if you look into a currency pair, uh, to understand how the exchange rate is changing in long run, what are the factors that affect the change in exchange rate in long run, we are looking into those conditions, and based on that we are arriving, and based on that we find the long term equilibrium level, and we'll get that with the help of these parity conditions. Now, in other words, I can write international parity condition. It describes the interrelation interrelation that interrelation between currency pair, because we are dealing with FX market, right? It describes the interrelation between currency pair that jointly jointly determine the long run. Again, it is for long run, not short run, but long run. That jointly determine the long run movements for, first one would be exchange rate. Exchange rate. That is how the exchange rate would be changing in future. Current spot exchange rate, future spot exchange rate, forward rate, etc. Then it also shows us how interest rate changes for these currency pairs. Interest rate, inflation, etc. International parity condition describes the interrelation between currency pair that jointly determine the long run movement for exchange rate, interest rate, inflation, etc. Okay. Now, but one thing we have to note is that it is usually these parity conditions, uh, for it to hold or it to be exactly correct, We are assuming an ideal world condition for FX market. But for these conditions, for these parity conditions to be uh, exactly correct, we consider it should be it should be an ideal or perfect market, ideal market condition. That is, what do we mean by this? For like all these five parity conditions will give us some formula, and that derived value to be exactly correct, in for that to be exactly correct, we are considering an ideal market condition. That is a market condition where there is zero transaction cost involved, because we are dealing with currency pair, right? So if a transaction cost for one currency is different from the other currency, then there would be differences in the value that we derive, and these conditions the answer won't be exactly correct. For the answer to be exactly correct, we are considering an ideal world scenario which usually doesn't exist. That is zero transaction cost for investing, trading. The second one is perfect information symmetry among all market participants. Perfect information symmetry among all market participants. So everyone would be making the decision based on the correct information that they hold. And the third point is risk neutrality for investors. Risk neutrality among market participants. All the market participants are risk neutral, so they can easily make a decision based on the information they possess. Risk neutrality for market participants, etc. Only when these conditions, that is the ideal market conditions, exist, using these parity conditions equations, we will be derive the exact value. Otherwise there would be minor difference in the value that we calculate. Okay, now another point that we must remember is, we have already discussed like these parity conditions exist in long run, right? So uh, these the first point would be, moving on, the first point would be these parity conditions uh, rarely hold rarely rarely hold in in short term. Uh, so these parity conditions, like to understand the future movement of exchange rates, uh, with the help of parity condition, we can only find a long run movement, not short run, because it is more difficult to predict the short run movement. An exception to this condition is, an exception would be exception is covered interest rate parity because it is completely hedged. We have already fixed the uh, forward rate at which we would be converting back the currencies. Hence, for the parity conditions can hold in the case of covered would hold in short term in the case of covered interest rate parity because it is completely hedged, covered interest rate parity. Otherwise, for the other four parity conditions, uh, these parity conditions don't hold in short term and only hold in long run. So they provide long run. They only provide. They only provide long term view of exchange rate. Long term view of exchange rate. Long term view of exchange rate. Okay. Now the second condition. Now the second point is parity conditions hold when there is an expected change in uh, market. Like parity conditions hold, like if I take into consideration expected versus unexpected change in market conditions, only in the case of expected uh, change in market condition, parity conditions hold. These parity conditions hold only when it is the market changes as per expected trend. Like if you know that inflation is on a rising trend, inflation is rising in uh, I'm taking A and B countries, and inflation might be rising in both these countries. Then we may infer that the inflation is on a rising trend, and that is an expected market condition. And under such scenario, the parity conditions hold. But under sudden unexpected change, such as the central bank of a country intervening with the FX market operations and bringing about some changes, that will be an unexpected change. And under such circumstances, the parity conditions or the calculated parity value won't hold because the market conditions have suddenly changed drastically. Conditions don't hold, and we have to calculate it again based on the revised market conditions and revised data. So an analyst should always be aware about the market conditions surrounding them and should make rational decisions. Like these models, these equations will help us to calculate or understand the value, like understand the movement of exchange rate. But it isn't exactly correct. As we discussed, an ideal world scenario doesn't exist. It only gives us a direction or an idea about how it might change. But based on the change in market conditions, we have to update our judgment and analysis. Okay. Now the third point is the parity conditions, like it shows relative the exchange rate movement. It shows relative movement. It is a relative movement. Exchange exchange rate is a relative movement. Relative movement, because we are considering two currencies, right? Movement, like uh, that is relative uh, relative price of one currency in terms of another. Relative price of one currency in terms of another. Okay. um an example would be, I'll take an example. If I take an example of the currency pair AUD to INR, um, Australian dollar to Indian rupee exchange rate. Now, to understand the exchange rate movement, to understand the exchange rate movement, um, understand the direction of exchange rate movement, we should look based on inflation factors. Like in this case, we are considering inflation factors. So based on inflation condition, we should consider the inflation scenario, inflation factor in both Australia as well as India. We should look into the inflation factors in both Australia as well as India, because it is a relative movement of AUD and INR's exchange rate movement is dependent on the market condition of both Australia as well as India. That's why it says exchange rate movement is the relative price of one currency in terms of another. And to understand the movement, we should look into the market condition of both the countries uh, whose currencies we are looking into. Okay. Hence, factors affecting the currency of both countries are relevant. Okay. Factors affecting the currency of both countries are relevant. Okay. That's all for an introduction about international parity conditions. Now we would be studying about covered interest rate parity. That is the first interest rate parity in this chapter. That is covered interest rate parity. We have already discussed about this in forward rates video. I have given the link in description. Please do watch it, because I'm not going to derive the equation again, because we have learned about it in much detail in that video. But I'll just give a brief idea about what covered interest rate parity is. Covered interest rate parity, it is an investment in foreign money market instrument. It is an investment in a foreign money market money market instrument that is completely hedged against that is completely hedged against exchange rate risk exchange rate risk. Okay. and 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 should yield the exact same return as an otherwise identical domestic money market instrument. As an otherwise identical domestic money market instrument. This is how the book describes it. That is, covered interest rate parity. It's an investment. Like, it can be an investment in foreign money market instrument, and it is completely hedged against exchange rate risk and should yield the exact same return as an identical domestic money market instrument investment. Uh, in simple terms, if I want to explain this, it would be, I'll take an example. So I'll take the currency pair AUD to INR. Here AUD would be the foreign currency and INR would be the domestic currency. Okay. Indian rupee is the domestic currency. Australian dollar is the foreign currency in this example. Now, an investor. An investor has probably 1 million. Investor has 1 million INR to invest for 3 months. Uh, for 3 months. What are the two choices? And the investor wants a risk-free investment. Okay, a risk-free investment. Risk-free investment. Now, what are the choices that the investor has? The first choice the investor has is the investor can invest in an investor can invest in a 3 month Indian treasury bill. Indian treasury bill. Okay. We know that it is the most risk-free one. Domestic government treasury bills are risk-free, are usually the most risk-free. Or since we have AUD, the second choice the investor would have is to convert INR to AUD. Okay, then invest in a 3 month Australian treasury bill. Treasury bill. After 3 months, after 3 months, once he gets the required return months, convert the principal and return amount, convert the investment back to INR. Okay. Uh, but while this conversion would, since this conversion would be taking place after 3 months, and the investor wants it completely hedged, since the conversion of AUD to INR takes place after 3 months, uh, to since the conversion takes place after 3 months, to hedge the exchange rate risk, like how the exchange rate would move again after 3 months, to hedge it, to hedge the exchange rate risk, um, the investor will already fix the forward exchange rate at which the conversion would take place. Fix the forward exchange rate at which conversion version would take place. Okay, that's how the investor will hedge his risk of converting AUD to INR back after 3 months, because he won't know how the exchange rate would move, right? So this is the two option that the investor will have if he has 1 million INR to invest, as per our example. Now, for the covered interest rate parity to hold, the return received on both the first and second investment should exactly be the same. That is what we mean by covered interest rate parity. So, if the investor invests in a domestic money market instrument, or the investor invests in a foreign money market investment, both the investments should give exactly the same return for covered interest parity to uh, hold, to exist. Otherwise, there would be arbitrage opportunity, in which the investor can invest in the currency market where he will make higher profit. That's why for covered interest rate parity to hold, both the returns should be exactly the same, otherwise arbitrage opportunity exists. Now, another one point is, again in this, like as we already discussed, for the amounts to be exactly same, we consider an ideal world scenario for FX market. That is, both these an ideal world scenario where the liquidity, maturity, default risk is low for both currencies, as well as the transaction cost is zero for this investment. Like transaction cost is zero for investment in INR or AUD. Okay, only then the amounts would be exactly the same. Like the return from AUD and return from INR to be exactly same. An ideal world scenario should exist where liquidity, maturity, default risk is should be identical and transaction cost should be zero. Uh, the formula is already discussed in the video I mentioned. The description link is given in the description. That's all for today's video. Thank you. In the next video, we would be covering uncovered interest rate parity. Thank you.